Today, on our exam review, we are covering a crucial topic for the Series 6 exam: the fees and charges associated with variable annuities. Understanding this is not just about memorization, it is about grasping the structure of the product itself. The exam will test your ability to differentiate these costs from those of other investment products, like mutual funds. Let's begin with the most unique fee, the mortality and expense risk charge, often abbreviated as the M&E charge. This fee is compensation for the insurance company that issues the annuity. What risk are they taking on? The mortality risk is that the annuitant will live longer than projected, forcing the insurer to make payments for an extended period. The expense risk is the chance that the costs of administering the policy, like record keeping, will be higher than anticipated. On an exam question, if you see a fee related to lifetime income guarantees or death benefits, it is the M&E charge. For example, a question might present a scenario where an investor is concerned about outliving their savings and asks which fee covers the annuity feature that protects against this. The answer is the mortality and expense risk charge. Next are the administrative fees. These are more straightforward and are similar to what you might find in other managed accounts. They cover the day-to-day operational costs, such as processing transactions, sending statements, and general record keeping. This is typically a flat annual fee or a small percentage of the account's value, maybe something like 0.25%. Finally, we have surrender charges. This is a very testable concept. A surrender charge is essentially a penalty for withdrawing money from the annuity before a specified period has passed, known as the surrender period. This period often lasts for several years, sometimes 7 or more. The charge is usually a percentage of the amount withdrawn and declines over time. For instance, the surrender charge might be 7% in the first year, 6% in the second, and so on until it disappears. An exam question could give you a surrender charge schedule and ask you to calculate the penalty on a $50,000 withdrawal made in year 3. You would need to find the third-year percentage and apply it to the withdrawal amount. A common trap is to confuse these fees with mutual fund expenses. While both variable annuities and mutual funds have investment management fees for the underlying subaccounts, mutual funds do not have mortality and expense risk charges. That M&E charge is unique to insurance products. Also, while a mutual fund might have a contingent deferred sales charge, or CDSC, which functions similarly to a surrender charge, the surrender charge is a hallmark of the annuity contract. To keep these specific annuity fees straight, remember the acronym SAM. Just think, when you buy a variable annuity, you have to pay SAM. S stands for surrender charges, A for administrative fees, and M for mortality and expense risk charges. This simple phrase, pay SAM, can be your mental shortcut on the exam to quickly recall the 3 main fees that distinguish variable annuities from other investments like mutual funds. Remembering SAM will help you dissect any question about the cost structure of these complex products.